Hi all, welcome to Cryptonite. This is a roundup of all things crypto. I am Shyam and I have Dr. Tejaswi with me. So Tejaswi, a lot of things happened the previous month. There was this huge crypto event in Brussels. Did you get to attend? And is all the nonsense that we are hearing actually true?
Yeah, so it was called ETHCC. ETHCC stands for Ethereum Community Conference. It is perhaps the biggest, or at least maybe one of the top two biggest crypto events in the world. Maybe definitely in Europe. Uh, so I was supposed to go. I had booked tickets in January of this year. The hotel, the tickets of the event, and the thing with crypto events is that typically the conference is organized in like one kind of building, which is like a building with multiple stages and all of that. But most of the attention is on side events. So people organize their own events kind of parallel to the main event. They will hire a coffee shop, a stage, a restaurant, a meeting room, whatever it is. So these side events eventually become the main thing. And it depends on which side events you are invited to, which side events you are allowed to go, which side events you find out through some secret Telegram channels or whatever it is. So it becomes this kind of uh, game of who do you know and how do you get into these events. And some of them are bigger and open, so you can just go there. The weird one was it's Ethereum Community Conference, but one of the biggest events was on Solana. So Solana had their own kind of side corner in the part of the city, and they were doing their own thing. Apparently, this was like a big event, so I didn't go for other reasons. I'll get to that later. But turns out it was a bit weird because getting a bunch of crypto people together in a city is like a ripe target for people with low morals. So essentially, what happened was a bunch of muggings, a bunch of carjackings, not carjackings, but a bunch of car break-ins, hotels rooms being broken into, general feeling of unsafe. Kind of, you just feel unsafe going from place A to place B. You don't want to walk in the night. And Brussels, though it's kind of weird because I have been to Brussels. I was there in 2014, 15. It was a perfectly fine city, good food, good beer, generally overall kind of good vibes. But this time, apparently, it was quite terrible. People are really unhappy about it. What was funny was a lot of the crypto people were complaining about this event that happened in Bogota, in Colombia, in 2022, when DevCon was held there. DevCon is another big event. And people were like, some people were like, why would you hold a crypto event in Bogota where people are known to be kidnapped and generally things are unsafe? But apparently in Bogota, really nothing happened. The worst was somebody lost their phone or something. Maybe even they just lost it themselves, right? But in Brussels, apparently it was much worse. So a lot of people were like, let's have it in Venezuela or Johannesburg or Mumbai or whatever next time, right? It's not worth idolizing these European cities. Anyway, that was one part of it. It was not too bad. Nobody really got robbed out of their crypto itself. Like initially, I saw like tweets saying, my car got broken into and I got robbed or whatever. Then it became jokes. My car got broken into and they turned out that when they went in, they saw that I had Cardano, and they then sent me an invite to their Telegram group of robbers. They're like, "You are such a poor guy. You are holding these really useless bags. So like, join us in our robbing group so that you can go and rob real rich people, right?" So the jokes they wrote themselves. There were so many jokes going around that this guy tried to show a gun on me, and when I opened my Ledger wallet and showed him that I had, I don't know, whatever, right, hex or something, they were like, "Oh no, poor guy, you are so poor. Join us or whatever." So anyway, that was a joke. But, it was. I am sure the jokes were not the reality. It definitely was much uglier than that. Anyway, so I didn't go because of other reasons. Prior in the prior week, a bunch of other people kind of got together and did a kind of an unconference, so to speak, where you basically go on. There's no events, there's no talks, there's no presentations. You just get together like 40 people, and then you kind of get them together in a single area without them being able to leave, and without them being able to connect to the internet. So you basically isolate them in a single location without internet and without external influence, right? And let them talk to each other, basically get to know each other. So I was in an event like that, which was pretty nice. Good to kind of I know these people kind of superficially, but getting to know crypto people in a fundamental way, or talking about deeper topics, because you are there 48 hours with somebody, you invariably end up talking about things that are more and beyond just price action or some other partnership or whatever, right? You get to talk to them about what motivates them, or why are they here, what was the defining moment of their startup career, or whatever it was. So there were a few VCs, not too many. I was one of them, but there were a few other startup founders. There were a few protocol engineers, few developer relation managers, API designers, just generally people who are involved in important projects. So that was a good. I went there last week. So this week I decided to skip ETHCC because just too much travel. But seems like it might have been a wise decision, because ETHCC was quite terrible, I heard. But coming back to the technical event itself, nothing major came out from the Ethereum camp. They're still working. They're still making the scalability roadmap happen. And as you know, Ethereum has a scalability roadmap that depends on what are called these layer 2 solutions, where only the settlement happens on Ethereum, but all the intermediate transactions happens in a different layer. That roadmap is still active. They are working on it, making it more robust, giving more guarantees. One problem with such a concept is that if you have two such rollups, your Ethereum liquidity is fragmented between these two rollups. So think of it as, if you buy like essentially, maybe I'll ask you about this question. If there are two stock markets in a country, is the liquidity divided between the two markets?
Well, it depends. So we had BSE for the longest time, right? So that was the OG exchange. But it was all like, like pit trading. So there was like actual people there. So when NSE came out, they came out with screen trading, which is electronically settled, right? Transparent order book. So it did drain a lot of liquidity away from BSE. So to a point where there was a time when a seat at the BSE to be a big broker was going at 5 crores back in the day, like in the 90s, and that collapsed, and it was treated as like a family sort of asset, right? So your dad becomes a broker. It was a license to mint money in the market, so to speak. So all that got smashed by NSE. So it is kind of true, and BSE has not come back to its old market share even today, even after the transition to screen trading and so on. And MCX tried to launch their own stock exchange called MCS SX. But they were not able to drain any liquidity. So NSE remains the predominant exchange in India. So it is, there is a bit of a division, but at the same time, many, as a end user, you want other people to provide you liquidity in as many venues as possible for the same thing, so that if one goes down, you have the option of trading in the other. So recently there was an outage in BSE. So the way these guys try to monopolize is that, so for example, Nifty 50 futures and options are available to trade only on the NSE, right? So BSE Sensex futures and options are available to trade only in BSE. But if you want to trade something like Adani ports, so they are available to trade in both exchanges. So people who trade Sensex, for example, were stuck because BSE F&O had some glitches and so on. So as an end user, you want liquidity everywhere, but as an exchange, you want exclusive contracts that trade only on your venue to hang on to that revenue source. So yeah, I don't know if that answers your question.
Yeah, no. So my question was, let's say the more interesting one is the Adani Ports case. In the Adani Ports case, let's say there is a market maker who will market make on both exchanges. How do they move the liquidity between the markets in case there is a flood of orders in one of the exchanges. For example, let's say they have 5 crore positions in both exchanges, and over there is a kind of a glut of order in NSE. How do they move the liquidity from BSE to NSE to quickly handle this surge of trading?
It's dynamic, right? So there is no question of moving it. So, from a market maker's point of view, it is one risk. So if if they're getting hammered on one exchange, they will try to offset it on the other.
Okay, so what I mean is, let's say they want to buy as many things are being sold on one exchange, but they want to have cash on the other exchange. Like they want to have rupees in the exchange, right, to be able to offset the trade. Do they have rupees on both exchanges simultaneously, or how does it actually work?
Not the exchange. So they will have a common clearing agent.
Oh, so how does
And
it work?
custodian.
There's no splintering of clearing agents. Is it a universal clearing agent?
See, for Aam Janta, right? The broker itself acts as a custodian and clearing agent. Okay.
Oh,
But if you are really serious about trading as a profession, right? You will need to have a third party. So Zerodha has this Orbis tie-up, right? So the idea is that Orbis is the one who is managing your collateral and clearing your trades and so on. And so what you do is you connect that same Orbis account to both to any broker you go to actually. So either it is Zerodha or if it is Angel or whatever, right? So you use the same code, and so they are the ones who are responsible for making sure that you're not tripping any margin
interesting.
requirement.
Interesting. So here, what happens is in the crypto world, what's happening is essentially if you are trading on layer two, which is like this. Let's say there are two layer twos on Ethereum. One is called Arbitrum, and one is called Optimism. So for Arbitrum, to bridge your ETH from the base layer to the Arbitrum layer, what you do is you look at the Arbitrum contract on Ethereum, you lock your ETH there, and then you mint the corresponding ETH on the Arbitrum layer. Now, this ETH in Arbitrum layer can do things only in the Arbitrum world. But if you want to now suddenly trade on Optimism, because there is some arbitrage opportunity that emerges on Optimism, or some idiot put a lot of sell order at a stupid price or whatever it is, you will not be able to buy it immediately because you don't have ETH on Optimism. Your ETH is stuck on Arbitrum. So what you need to do is you need to burn the Arbitrum ETH, take it out of the contract on the base layer, and then move it across to the other layer. So it has to be like a physically done action. You have to actually, it takes like maybe 24 seconds to do this, because each Ethereum block of finalized transactions takes 12 seconds. This whole transaction has to happen, and then you are able to have ETH on the other side to be able to buy. So this is typically called liquidity fragmentation in this community, where if you have many layer twos, they all kind of capture some liquidity of the base layer, but they are not fungible immediately. The fungibility is a bit slow, because you need to actually move the ETH from one layer to another layer, and that actually causes some transaction delay, and that might lose you the opportunity to trade.
Yeah, so what you're describing is common in this ADR trading setups. So you know what ADRs are, right? American Depository Receipts.
No.
Okay, so
Please educate me.
okay, so for example, if I'm a Indian company, right? When I have a bunch of investors who want to trade my stock. So what I do is I list my stock in the US as an ADR. It's called the American Depository Receipt. Now, those ADRs reference Indian stocks trading in India, but they are listed in the US. So in the simplest case, think of it as a pointer, right? So it's just it just points to Indian stock. Now, since it's listed in the US, there's obviously arbitrage opportunity, in terms of currencies and also market hours. And The
Yes.
biggest problem there for people trying to trade this is one single entity does not cover both, right? So in India you have to follow Indian regs and Indian margin and Indian broker and all that stuff, and in the US you have to manage that. So and if you see an opportunity where you want to buy, say, the ADR and sell Indian stock, then those two legs are only in your mind, so to speak, because for
Yeah. So you take
each
the
guy
risk.
it is
You take the
difficult.
risk of you take the risk of both the legs in some sense.
Yeah. So it's common in that situation, and one is trading in dollars, the other is in rupees. So what you mentioned is similar to that.
Yeah. So this is fairly common in Ethereum world where liquidity is fragmented across layers, and they are trying to make more efficient solutions to bridge this. Because what happens eventually is all the ecosystems become smaller and smaller because they basically are only a small window into the base layer essentially. So this is something they're working on pretty aggressively. And one of the themes of each CC was how do you do cross-platform liquidity kind of merger in some sense, right? Which is not easy because essentially you don't trust these systems. The system A doesn't trust system B. So it won't be willing to take system B's signatures as valid. It will only take the base layer as valid. So there is a bit of a trust issue, and bridging that trust with cryptography is a possibility. And that's where some novel cryptography is also coming in. And it's an exciting area. So I actually follow this research quite closely. And just to show that, crypto is kind of reinventing or better inventing a bunch of these problems that TradFi has faced for the last 50, 60 years. And maybe they're reinventing them poorly. But you could also argue that they're maybe reinventing them from first principles without kind of relying on trust, which is an interesting way of thinking about it.
Look, the problem with TradFi is not lack of brains. Like, they would have invented this, if it was required. The problem with TradFi is it always boils down to, KYC, AML, and, cross-border flows of capital, and governments trying to either stop it or encourage it, right? So, I had asked you, what is the easiest and best place to open a crypto account, and you said, do it in Binance. So I opened an account in Binance. They asked me to do KYC. I did KYC, and then they said, okay, to get an API, to use the API, just do a 10 euro transfer or whatever. And I said, okay, I'll do a 10 euro transfer, and that's where they blocked me, saying, we have to do some additional checks. We don't know what it is, but we'll get back to you, right? So all this is because the Indian government really donked them, for some reason, and I don't think they're allowed to open new accounts or whatever. So, uh,
Yeah,
so
yeah, I'm
even
not surprised.
in the
Binance was not in the God.
so even in the crypto verse where things are supposed to work, with freedom and all that stuff, that's not entirely true because the gatekeepers end up being exchanges, right?
Yes, the on ramps and the off ramps end up being really complicated. It's actually true. So essentially, the idea is that's why if you realize this, you see why stable coins are so popular in crypto. Because when people want to keep their money back in dollars, let's say they want some Bitcoin exposure or Ethereum exposure, but suddenly they decide that it's too much or too hot or whatever it is, and they want to move to dollars. Moving it to like a real dollar in a real bank account is a pain in the ass. It's really difficult. So they essentially use these kind of trusted stablecoin products where there is dollar denominated tokens floating around in these blockchains. You have dollars on Ethereum, dollars in Tron, dollars on Bitcoin, dollars on wherever, right? And that kind of gives you this kind of illusion that you are in a safe dollar haven. But again, it's again dependent on some trusted third party who is holding the dollars, the real dollars in a real bank account, which is regulated by some entity. And then they will offer these tokens to you on these blockchains. And you believe that it's all kosher and safe, but invariably the dollar holder can definitely influence whether you will get your money back or not. It's how it is, and it's how people have accepted it to be. Like a lot of crypto influencers will tell you that stable coins are a product that has found product market fit in crypto. But that is kind of missing the point, in my opinion. In my opinion, the point is that crypto itself has not found a product market fit, and stable coins finding a product market fit is a way of saying that the place where crypto intersects with the real world is still problematic, and that bridge we will transfer or we will mitigate with some trust, and that is the product that we will sell, which is a I'm not convinced. It's a very absurd and somewhat contrived way of thinking about products and markets. So anybody who tells you that stablecoins have found product market fit is telling you a story which is somewhat contrived, because of course it's true that if you are an Indian and you want to hold a dollar, it's harder in a Canara Bank, but if you hold it in Binance, it's easier. But it's because of so many other reasons, which are either loopholes or regulatory arbitrage or whatever it is. It's kind of, yeah, I'm not convinced, but I hear this so many times, and I wanted to vent about it a little bit.
Yeah, I mean, it sounds to me it's not like stable coins found a product market fit. It's the dollar that found the PMF in the crypto world, right? Not the other way around.
Yeah, you could say that. You could say that. I mean, that's pretty much true. So anyway, this was the long and short of attending or not attending ETHCC in Brussels. I got a lot of other side events which are interesting. Have I discussed fully homomorphic encryption on the podcast before?
No, I don't think so.
Okay, let's let's do what is called a science corner in the All In podcast world, right? So I don't know whether people are aware of the All In podcast. It's kind of this popular tech politics podcast from the US, where every number of episodes, David Friedberg will do this science corner where he will talk about some new scientific discovery. So one scientific discovery in cryptography that I want to talk about to our audience is this idea called fully homomorphic encryption, which sounds a bit complicated. Let's call it FHE. So FHE is essentially a new kind of encryption where you can actually compute on encrypted data. Essentially, this is what happens. Let's say you take the value 1 and you encrypt it. In the traditional world, when you encrypt the value 1, you get a bunch of characters that look like garbage. You encrypt the value of 2, it also looks like garbage. And if you add those two garbages together, you actually don't get the encryption of 3. You get some garbage which is undecryptable. If you decrypt that garbage sum, you'll get some random number. It's completely random. It's the encryption is not amenable to adding. So let's say you can invent an encryption scheme that is amenable to adding, but that encryption scheme will not be amenable to multiplication. So for a long time, an encryption scheme which is amenable to both addition and multiplication was being searched for. It was a holy grail of cryptography for a long time. And in 2009, there was a seminal paper from a guy who was doing his PhD in Stanford, which actually solved this problem, where he had a scheme of encryption which allows you to add the encrypted values and also multiply them. And when you decrypt it, you get the actual product or the sum of the plain text values. And for a long time, this was considered to be like a theoretical result with no real practical implementation. There are lots of applications. The applications are kind of obvious if you think about it, right? You could, for example, keep your data with Google, and Google can do its search or whatever it is for you without actually reading your data, which seems fantastic for all privacy reasons. But the scheme itself was very complicated, and it was like a very expensive operation. The encryption would take 4 hours to run, and then the multiplication would take 2 hours to run. And that was just impractical. But over the last 14 years, 15 years, it has become faster and faster and faster. And I would say maybe 1,000 to 10,000x gains have been done. And now it's takes in the order of seconds. But there's still a long way to go where it becomes an order of milliseconds. And there's another 1,000x improvement required, which will probably happen in the next 5-6 years. But the cryptocurrency world is going all in on this because they believe that it's a way to kind of show your application of cryptography and to incentivize the right actors. You introduce a cryptocurrency in the mix, and voila, everybody is happy. So there are a bunch of startups doing fully homomorphic encryption, and they had a big presence in ETHCC this time. A lot of talks, a lot of venture opportunities, a lot of developers building interesting applications using this technology, and also trying to cater to Web 2. So trying to see if Google or Microsoft will will bite into it, which is interesting because Google and Microsoft have already kind of worked on this a little bit. They've had some work on this from 2015, 16, 17, when the crypto bros had not discovered it yet. But still, crypto bros are advancing it faster than the Web 2 incumbents, which I think is kind of fascinating. So anyway, this is a cool scheme. And one aside is that the encryption scheme itself comes from an area of AI. So one of the AI schemes actually leads to you encrypting values for other reasons. And that scheme happens to be homomorphic in nature, which is that it's available to adding and multiplication, which is a crazy, I would say, an inexplicable merging of domains in a world which you don't understand. In the world of abstract mathematics, it turns out that this one machine learning technique and one encryption technique are the same, which is one of those things where you are like, how the hell is that true? How the hell is it even possible? And that's when you realize that you don't understand the abstract world of math is still kind of beyond our comprehension sometimes. So it's kind of nice. Anyway, that's the science corner of the day.
That's pretty interesting, man. I mean, look at it from an analyst perspective, right? You only look at prices, right? So, oh yeah, Bitcoin went up, went down, and that's all that gets reported in the media as well. Whereas the real sort of innovation and the actual interesting stuff is happening, as a side effect of of crypto and not the main effect, so to speak.
So speculation drives innovation in a weird way, and that is I would say it's one of those things where like nobody would have anticipated that ZK, which is zero knowledge proofs, or fully homomorphic encryption, these technologies would ever hit mainstream. It was completely inconceivable 15 years ago that these people would work on it as a commercial venture. And now, because of crypto bros coming in, things have changed a little bit. And I think I'm happy about that.
Yeah, I think the term speculation drives innovation is something, we need to make a big banner tied to a plane and fly it across SEBI's office,
Yeah, SEBI in its quest to protect the investor has made it hard, huh?
No, the funny thing is, so they went after. So there is this huge process of identifying stocks on which derivatives can be listed. Okay, so they have like a 5-page thing about it. Now, I went through past year's data to see how many stocks, how many futures contracts has NSE listed, since like 2007 or something like that. And honestly, it's sort of like a mean reverting number. So derivative contracts has remained within a range, whereas the stock market itself has gone from a few billions to a trillion, the market cap itself. So these guys have put an artificial cap on, in their mind, like 150 futures. That's all they want to see. It's probably because that's all they can track in their Access database or something like that. So that's all they want to see. So they keep penalizing the market for for growing beyond that. It's just incredible.
Yeah.
So anyway, that's why
good rant about SEBI, because I think SEBI deserves. But I don't know for some reason I have a soft corner for SEBI because I have a feeling that because of them, the mutual fund industry in India got its act together for the most part. So I have a soft corner for SEBI, but it's definitely, as a libertarian, I feel that all regulators should kind of disappear, but that's a different story.
Yeah. So the problem is that speculators will always find a venue to speculate, right? So you're not going to stop them. And I think in the last Cryptonite, you had mentioned that some Indian companies were giving KYC access to derivative access to to crypto. And those
Yes.
idiots took out a front page ad, since
Oh,
then.
really?
And yeah. So this Zerodha guy, Nikhil Kamath, actually, tweeted it out saying, while we have to jump through hoops, and be this model actor for the whole world, you have this backdoor entry which nobody is looking at. And if you are going to squeeze out, reasonable speculation in the main market, then people are going to get the kicks from all these other venues, right?
Yes, indeed,
So
indeed.
yeah, so it's just
Did
stupid that
did it actually did they take out a full-fledged ad in the papers?
yeah, it was in the Economic Times or something. So
Oh my goodness. Yes, sir,
yeah.
I can find it. This is surreal. I did not expect them to do this so obviously.
Yeah. So now,
Okay. Okay.
the hammer is going to come down on them as well, because
You think it's actually possible that SEBI will take it into serious into serious consideration?
see, right now there's a fight going on, right? Because the RBI thinks that they are the regulator and they are the gatekeeper. So they have some rinky-dink license that they are giving, um, crypto uh, firms in India. And he unfortunately has not been involved in this, I think. So I think it's just asking for trouble at this point.
Interesting. Yeah. I see this ad, and it's yeah. I think Nitin Kamath has a point. It is, and he also has tagged Nirmala Sitaraman and Finmin and all of these other guys. Which, oh my goodness. Okay, for popcorn time.
Yeah. So speaking of popcorn, what's going on with this polka dot?
Oh man, Polkadot got into a bit of a soup a couple of weeks ago. So for those who don't know, Polkadot was a blockchain that was supposed to fix all of Ethereum's problems. So when Ethereum was launched in 2015, Ethereum was supposed to fix all of Bitcoin's problems. And Ethereum, of course, had its own problems. And Polkadot said, we will do it in the right way. And they had some credibility because one of the creators of Ethereum, Gavin Wood, was the creator of Polkadot. So he actually kind of had his ideas that were like, once you implement a system in the real world, you get to kind of figure out what the flaws are and how they could be better implemented. So he had some notions on how to fix it, and he had launched Polkadot, which was pretty big back in the day, one of the bigger ICOs from 2017, I think. And then they raised a lot of money from the ICO. I would say in the billions of dollars, maybe a couple of $1 billion. I should look up the numbers, but it's about that range. And that money is with them right now. The Polkadot Foundation has that money. And of course, over the period of last many years, they have not innovated, or they have not gotten enough applications to build on them. And they have become like this, I don't want to call it ghost town, because there are some real projects on Polkadot. But it's for the purpose of attention, at least. Other than Bitcoin, Ethereum, Solana, and a bunch of new crypto projects, Polkadot doesn't get as much attention as it should ideally, because they have some good projects. Anyway, the point being here, the foundation has a treasury which is whatever $1.5 billion big, and they are spending it quite interestingly. So they released a treasury report, and they have spent $90 million on marketing, $30 million on developer relations. This is 1 year, by the way, all of 2023. The best part was they spent, I think, 100K or something on one of the websites which lists cryptocurrencies, where the Polkadot logo will rotate. And it's an exclusive rotation, not given to other crypto projects. So they paid $100,000 or $50,000 to one website where they could get a GIF where their logo would rotate when you list all the coins. That's kind of emblematic of how terrible the spending was. They spent $200,000 on a food for a conference. They spent millions of dollars on, I don't know, whatever else. It was a bit of a joke. Of course, they came back and said that, it's all accounted for, it's all budgeted for. We have a plan and whatever it is. But generally, it shows you how terrible, unaccountable governance can be. Like this is kind of one of the reasons why you have regulators to some extent, because the polka dot holders of the coin, the dot token holders, have absolutely no right in how these money is being spent. In a practical way, in a theoretical way, they have a part of a DAO, and the DAO votes on all these spending decisions, and the stockholders or the token holders control the spending amounts, which happens in many decentralized protocols. For example, the protocol Aave, which is like this the protocol that governs the Aave lending market on Ethereum. The DAO is that if you go to the DAO proposals, there'll be things about how much do we pay this engineer who is doing this particular programming task. Should we pay them $120,000, $100,000, $180,000, and the holders of the token will vote on this. So there is a proper decentralized governance happening, which is probably an overkill because you don't want token holders to be involved in that level of detail. On the other hand, you have absolute lack of accountability with the Polkadot ecosystem where the governance is they're spending money on completely random things. So there is a lesson that crypto is learning in a harsh way from this particular kind of these events, and hopefully, if not self-regulation, some regulator will think that the token holders' rights are being trampled, and they will come after these projects. I don't know when that will happen. I'm sure it will happen. It's just a matter of time before enough voice of token holders will reach politicians, and it will happen soon. So that was kind of a sad thing. Speaking of which, some treasuries though have professional managers, which is kind of fascinating. So, for example, the Gnosis DAO has I would say around $500 million in its treasury, and they give it to this professional manager who manages it on chain. When I say on chain, I mean they do on chain strategies. They will say they will do this long short strategy of this particular DEX, trading this particular token, and they will give a 2% yield or a 4% yield or a 10% yield or whatever it is. So there is a full cottage industry in crypto of treasury managers who are doing it on chain, which is kind of cool because if it's on chain, the treasury token holders know where their money is being spent or how the money is kind of being managed, which is kind of fascinating. So again, from a TradFi perspective, you knew all these things were happening in all these companies, but kind of they were done in a way in which it was not kind of publicized. All was legit probably, but it was still kind of hidden. In the crypto case, everything happens in the open. It's kind of funny to see them. At least most things happen in the open. There are some backdoor deals as well here. So again, the theme of our talk is that crypto is kind of reinventing traditional world in a maybe inefficient, maybe corrupt, or maybe efficient and maybe safe way. Maybe it's case by case, where each case is different.
Yeah, I think a lot of crypto's stuff is shady, right? So you had written about Mount Grox hack a long time
Mount
ago.
Gox, yeah. So Mount Gox actually came back to the forefront this month. So Mount Gox, for those who don't know, was the largest Bitcoin exchange back in the 2013, 2014 era, when Ethereum was not even live yet. So it was Bitcoin, maybe Litecoin, maybe there were a couple of other coins that have disappeared now. Litecoin is still there for what it's worth. Mt. Gox at some point custodied around 1 million Bitcoin, maybe not $1 million, of 1 million actual units of Bitcoin, which is a huge amount of money now. Even then, it was a reasonable amount of money. And Mt. Gox was based in Japan, run by this guy, Mark Narpels, who was a good guy, probably, for all I know. But they had a hack, like a massive hack, which drained a whole bunch of Bitcoins from the exchange. And they went insolvent back in 2014, I think. And the insolvency, at the time of insolvency, they lost around 750,000 Bitcoins worth of value. And that case has been pending in courts of Japan for a long time. And it finally got resolved. And the customers of Mt. Gox at that time are now supposed to get their money back. But they're not getting Bitcoin back. They're getting dollar-denominated money back. So whatever the Bitcoin price was back in the day, which was I think maybe $400 or whatever it was, or $300, that amount of money will come back to you. If you, for example, let's say you held 10 Bitcoin in Mt. Gox and you got your money got robbed, you will get whatever $5,000 now, as opposed to $500,000. So that is quite sad. But because the money was actually lost, Mt. Gox really cannot do anything about it. They had a part of their treasury in some other account which was saved, and out of that treasury, which has appreciated considerably now, they're paying back money back, which is honest and fair. But I guess it still misses the point of crypto hacks being real. And once you lose crypto, it's kind of gone forever in some sense, which is sad for Mt. Gox customers, but that's how it was.
Right. So I guess like nowadays, if you just want to speculate and don't really care about crypto as such, you just do it with derivatives sitting on top of crypto, right? So you
Yes.
won't get involved in actual buying and selling of Bitcoin. Probably do the
you don't take custody. You don't take custody at all. You don't take custody at all. You basically do derivatives trading. Specifically, you do what is called perpetual swaps. And perpetual swaps are like basically they are these options or these derivative instruments which don't expire and they keep rolling over. And you get exposure to the actual price of the asset without actually even coming in touch with the asset. The only question is, do you trust the exchange itself? Because the exchange should have your fiat dollars to kind of offset these trades that they do. And if they run with the fiat dollars, you're kind of screwed. And these exchanges are not sometimes, regulated in a right jurisdiction or whatever.
Right. So I was looking at Bitcoin and thinking, trading just perpetual futures, the simplest one of it, actually makes sense. So 24-hour trading, and you can chop it up into like 1 hour segments or 15-minute segments or whatever, and then construct a portfolio that rebalances on the 15th minute of within a 24-hour segment, and then treat it as a as a single portfolio sitting within 24 times 4 segments. And it makes sense from a risk management point and all that. So I was thinking maybe the next step would be to actually get some data out of Binance and see how the liquidity works and the margin requirements and all that. And that's where I kind of hit the roadblock.
Of course,
thanks to
KYC. Thanks to your KYC friends.
Yeah, I don't think it's KYC to reach a settlement with RBI or whatever, and there are more. They're waiting for the license. So they created a special type of license for for this new age finance guys, and that is not handed out in a transparent way, I guess. So
what is the license called?
I forgot what it was called, but all Indian guys, if you look at it, look at their website, they'll mention it. So
it's a Ministry of FinMin something. I know what it is called. It's some guidelines for being like a digital asset manager or something. I remember some companies approaching our fund. We had one Indian startup pitch their product to us, where I was like very skeptical about the regulation, and they told me that this is the regulation they have, and they have given it to like maybe 20 players, and it's pretty obscure players. They are not your usual well-known actors. So I know what this is. I maybe we'll put it in the notes as to what the actual name is, because I can look up my Gmail and find it.
Yeah. So without that, you're not allowed to take money from the oppressed class.
Yes. Of course. Speaking of Bitcoin again, did you notice that one of the reasons why Bitcoin price was somewhat tanking over the last month was speculated to be that the German government, which had I would say around 50,000 Bitcoins, has been liquidating it steadily by transferring it to Kraken, Coinbase, Binance, wherever. Because they don't want to hold Bitcoin, apparently. They want to hold euros. And I have no idea why they are interested in shit coins whatsoever. But that's apparently the way they're going to do this. So anyway, jokes aside, I spoke to a German friend of mine as to why they're liquidating so aggressively. And apparently it's by regulation. They are not allowed to hold other assets. If they seize gold, if they seize guns, if they seize anything which is not euros, they're supposed to liquidate it within a time window. And apparently the government of Saxony, which is the state that is doing this in Germany, they actually probably waited for the longest time they could, holding on to the appreciation. And at the tail end of the window, they had to sell. They might have sold at a better price maybe like a couple of months ago, but apparently they did do the right thing. But it was kind of funny that the jokes were basically German love for shit coins or whatever it is, which is, it's a funny joke, but I guess you do what you can, and it's kind of, I guess, you do whatever the law tells you to do, especially as a government, right?
Yeah, and the other piece of government news is that after the longest streak of central banks sort of shitting on crypto, the Russian central bank was like, "We are going to adopt crypto now. We're going to use crypto everywhere," because the sanctions pretty much turned off the tap for them, right? So now they want to settle stuff in like stable coins or whatever. So they're really trying to push crypto to all corners of the
So
market.
stable coins will be hard for them because the two biggest stable coins in the world right now, USDC and USDT, which together amount to, like, I would say around 150 to 160 billion of assets. They're both very US friendly. So USDC is fully in the US. It's a Circle, which is like a US company. So they will block all these transactions. And USDT, which is kind of headquartered in Panama or Switzerland, or depends on where you look and how you look. They are a bit more, I would say, grayer. But they have historically proven that they are very happy to listen to the US OFAC regulations, and they will censor or block all transactions that are not kosher, uh, which is going to be interesting because Russia, at least dealing with stable coins, will be not as easy. So they might resort to Bitcoin, which is of course easy, but that will be taking on price speculation, which is always going to be challenging. So I'm curious. I hadn't heard of this Russian news. I'm going to look it up now.
Yeah, and and I think the Tornado Cash case is moving through U.S. courts.
Yes, it
And
is.
apparently, the judge asked, one of the questions that they were supposed to answer was, do we need to show that the money launderer benefited from, actually laundering the money? And the reply to that was, there's no such thing as a philanthropist money launderer, right?
Oh my goodness. Actually, it's interesting because even the Samurai Wallet case is also going forward. Samurai Wallet was Tornado Cash, for those of you who don't know, was an Ethereum coin mixer, which is quite sophisticated for what it is. On the Bitcoin side, which doesn't support smart contracts, so you can't build something as sophisticated as Tornado Cash. They built a much more rudimentary version of coin mixing, which needs a central actor. Always, a central actor is essential to the protocol. And one of the central actors was this wallet called Samurai Wallet, and those guys got busted by the Department of Justice maybe 3 months ago. And the guy who coded up Samurai Wallet has supposed to wear an ankle bracelet, and he's on bail right now, but he can't move out of radius of whatever 2 kilometers from the nearest FBI office or whatever it is. It was kind of funny to see that I had seen a TV show on TV where this guy, FBI employee or whatever it is, he was on an anklet, and I had thought it was like a fictional thing. But apparently, the Samurai Wallet guy is also on anklet and roaming around in Portugal or wherever he is around the FBI office, which I thought was quite funny.
Yeah. So, fuck around and find out, I guess.
Ouch, 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 ouch.
All right. So, any VC gossip? Polychain,
VC gossip.
Eclipse?
Oh man, VC gossip has been terrible this month. Especially one specific case has been. It's a gift that keeps on giving. It's called Eclipse. Eclipse was a very interesting project. And we had looked at it as well, and we had looked at it kind of after they had closed their round, so we did not get in. But maybe we wouldn't have gotten in. I'm not sure about that. In retrospect, hard to say. But anyway, the project became a bit infamous because the founder had a bunch of sexual harassment allegations against him like a couple of months ago, and he left the project. But that was kind of, one person, bad actor, whatever, so you can kind of let it go. But turns out it's not that easy, because what they'd done was to raise money from VCs. They had given advisor shares or advisor tokens to a bunch of the VC general partners. So let's say you're a general partner in a VC fund, you get personal allocation of advisor shares under the table, which is not visible on the cap table. And then the GP will push the deal through in their own VC firm and get the funding for that company. The beauty of this particular case was the VC GP advisor allocation was higher than what the VC fund itself got from this particular project. It was quite bad, in like really bad behavior by all actors involved. But the advisor GP guy, he quit. He has left the company now, and he's the founder of another crypto project, which is a different story altogether. He has claimed that it was all above board, all kind of done legally and all that. So this is all alleged. There is no enforcer. There's really no mechanism to kind of. The VC fund has no real legal defense against the GP who quit. Generally, there's nothing really to do about this except for just wondering about how scammy crypto is in general.
Yeah, and what about the LPs? So for them, one big tenga, no? This is.
Yes, the LPs of the particular GP of the VC fund should be upset, should be holding the VC fund to some account somewhere. But it's hard. I think the terms of service are always going to be favorable to the VCs. Maybe I'm not sure how it's going to work out. Maybe there are more lawsuits coming. We'll wait and watch.
Right, and
welcome to crypto.
Well, as in TradFi, everything eventually will settle down after litigation, I guess. So
yeah, I guess. Which is, code is law, can be damned.
Yeah, right.
I mean, it should kind of show you at some level, right? Like, to give you a counterpoint to this, just to not let all hope about crypto be all pessimistic and negative, right? So Bitcoin is the current software version. The main client is at V24 or whatever, and V21 kind of went at the end of life level that is declared for it. And when that end of life declaration happened, a lot of the developers disclosed the bugs that were closed in that version, which went 4 years ago. And the bugs were disclosed today, because you don't want the bugs to be disclosed when the software that is vulnerable is still running on the public network. So they kind of figured out that enough software has been upgraded to the new versions, so disclosing the old bugs was okay. And I'm like looking at those bugs to see what kind of crazy bugs there were that was fixed, And it just shows you, when you look at the bugs, they're so obscure and so difficult to simulate and so difficult to really exploit. But still, they were closed very meticulously with responsible disclosure, all happening in a secure way across secure communication channels. And the bug fixes were made to look innocuous. So there's one bug which could, take out a node fully offline. So you're running a Bitcoin node and somebody can take you down. And that was because of some quadratic operation on a list, essentially. And the fix of the bug is like, they basically limit the size of the list in one bug, one fix saying that, because you don't need a big list or whatever. It doesn't tell you what the bug is. It just tells you that it's a cleanup or whatever, right? And then the second fix after like a month, there's one more which says, we'll optimize this algorithm for whatever, right? And over the course of these two fixes, that bug is actually fixed now. And after 3 years, they disclose it, saying that this was the bug and these are the fixes and this is why we did this. And one more was about some absolute number conversion or whatever it is, which had a small bug, and that could result in an obscure attack where, if some real conditions of 200 nodes come do this together, something will happen. Again, all those bugs were really valid bugs. They were fixed quietly, but they were bugs that were so, I would say, fringe and not really gonna take away anybody's Bitcoin out, right? And Bitcoin is hardening itself every iteration slowly but surely, to a point where it really can become like gold standard money, right? Like gold has evolved itself over billions of years to become what it is. And of course, Bitcoin is not comparable in a true sense. It's not physics, it's not chemistry, it is still software. But even at software level, a lot of these small things have to change over time. And eventually, if the code kind of really becomes solidified, you know that it's somewhat hardened to an extent where most obvious bugs are completely squashed. They are not there. And that's why sometimes when I look at move fast and break things in other crypto projects, I take it with a grain of salt. I take it with a grain of salt saying that these are projects, these are ideas, these are attempts, but they're not money. They're not even close to being what Bitcoin is, which is comforting. But also at the same time, innovation has to happen at the speculative level. So we are happy about that. But we are also happy that the foundations are laid and becoming stronger and stronger. So that was my hopeful, optimistic moment of the day.
No, I get that, but you spoke quite a bit about security, which I get. But at the same time, security is more of a people thing rather than an actual tech thing beyond a point. Okay, so I don't know if you've heard about AT&T's massive data leak, right?
Yes, I heard that.
Yeah. So they dumped all this on on a Snowflake database, into Snowflake, and without any sort of data governance or anything around it. And now everybody's data is out there, including text messages and what have you.
Yes.
So the thing is, yeah, I mean,
No, but
this
I mean,
was not a technology problem.
No, it is at some level. I'll tell you what's the difference, right? The difference is whenever you have centralized actors, technology and people together will actually make a difference. But when you have a decentralized system, a single person really cannot fuck up that much. But a single software change that kind of goes around as a viral software, and this bug is in every piece of software that is out there, then you have a real problem because that bug can be exploited dramatically. I'll give you another example of this situation. So, for example, all these packages that we use as a part of software development, we download from JavaScript repositories, Perl repositories, standard library of C++, or Python package manager. All of these libraries are very standard and they're used by everybody. So when you, for example, set up a new desktop machine or a development machine, you will say install standard library of C++. You don't even think about where the code is coming from. It's coming from some repository that the C++ Foundation maintains somewhere, which is replicated across the world, and you just get a copy of your zip library or your whatever library, right? Imagine if the cryptographic library that you download has a malicious bug in it that is trying to take your money out. And this is what happened. This is not theoretical. It happened last month. One of the crypto projects called BitTensor, their library on the Python official package manager was compromised. And somebody put a fake library there, as in it's a real library, but it has one extra feature, which is whenever somebody enters a private key in the software, it will send it to a remote server controlled by the hacker. As simple as that. And that was accepted by the Python package manager because Python package manager doesn't really know whether this is malicious or not. The owner of the project has to take care of that. And the owner of the project messed up by allowing this particular library to go through. And whoever installed it got compromised. So in Bitcoin, similar thing can happen. Let's say in the next version of Bitcoin that is released, whoever approves the software might approve something that has a bug in it. And that's why you have so many eyes looking at that particular software, and so many people are reluctant to upgrade to the new version because they are scared of these bugs. So till it becomes battle tested, they don't really upgrade it. So you're right for the most part, because eventually there are owners and the owners can mess up. But as long as the owners are not too centralized, and as long as the project has enough eyes on it, I don't know, man. I don't know. I mean, I kind of see where you're coming from. I get it. Hopefully things will be okay.
Yeah, I think it's going to get worse because of these co-pilots, so to speak. So my Twitter feed is full of people exploring it.
Yeah. No, it's gonna get worse.
Yeah, I think I mentioned this before as well. So like a co-pilot hallucinated a solution saying that, this just use this package, and that package did not exist. Okay.
Yeah, I know.
Yeah. So there's a massive sort of opportunity there to, run a copilot, see what it hallucinates, and create that malicious
create
package.
that package exactly, and exactly, and then you can do all sorts of bad things with it, right? So you don't even have to hack some existing package. You can just
Yeah.
upload a package that doesn't exist and get Copilot to say what that is, right? I mean, yeah, I know, I agree with you. That's not an optimistic note, but I guess we end it at that note.
All right. So thanks for tuning in to this month's Copilot. So Tejaswi, thanks once again. See you guys
Take
next
care
month.
and have a
Bye.
have a good July and August.